And then when it's done, will you just be here? Yeah. Okay, perfect. Thanks. Thanks, Elliot. Okay. As everybody gets settled, I have 3 sets of handouts for you. There's a copy of the outline. There's a copy of the old exam. Some of them are yellow, some of them are white. So just send some back. And then
I'm going to hand these in.
Yeah.
I'm not going to say. I'm just going to watch them.
Sure, it's fine. Okay.
All right.
Sure. So 3 different handouts. The outline, a copy of the old exam, and the answers to the practice calculations for the unlevered beta at the very end when we talked about the acquisition of Applebee's by IHOP. We did a little bit of, sort of manipulation of the unlevered beta formula to estimate what the beta of IHOP would be after it took on all this debt to purchase Applebee's. And at the very end of the handout, it says, here, recalculate the cost of equity based on the new debt to equity ratio, and then recalculate, nope, they're all out there in the rows. And then recalculate the new WACC. So the math answers to that is coming out in a handout that I haven't posted on Blackboard yet, but I will. So look at that handout. It's got some specific math to it, and I will post it later for the people that are not here. So the first thing I want to do is go through the outline. And this test is always much harder for me to make up than the midterm because I feel like, there's only so much that you can put on it. Since the midterm, we have done nothing but sort of discounted cash flow, weighted average cost of capital, corporate investment type calculations. And there's really only so much that I can put on the exam, but I have to, manage to be creative and find a way to write 2 tests that are different, but that I think are, equally difficult or equally easy. I was very brilliant on Monday to bring in a roll sheet that had a column on it that said, check if you want to take the exam early. I know I took that roll sheet back to the office, but I cannot find it. So at this point, I don't know how many people want to take the exam on Friday, but it's at 9:30 on Friday. And just raise your hand if you think you might be interested. I'm trying to figure out if I have to get a room or we'll do it in the office. Okay, we'll just come to the finance office and we'll put you in the conference room. Yeah, the question is just how many people want to do that. I'll probably send another email out, but Kim and Alex, I know you guys want to do it early. That exam gets curved in with the rest of the exam scores, but I don't try to make it harder. I don't try to make it easier or anything else. I just try to do 2, equally easy or equally challenging exams. One thing I think that most of you will find about the final that's different from the midterm is that you have more time than you need. People start to look around, they kind of start to daydream. If you are done, you got plenty of other things to do, with your life. You don't have to stay. You don't have to, feel like you got to stay for 2 hours and 15 minutes. You have the whole 2.5 hours. In the morning, when this class is offered on Tuesday, Thursday mornings, the final is always at 8 a.m. And I tell people to be there by 8:30, but that they don't have to be there right at 8. Our final is in the later part of the day, so I'm expecting everybody's going to be here at 5, and it's from 5 to 7:30 in this room on Wednesday if I don't see you in the finance office on Friday morning. So the first thing I want to do is go, through the outline and just see if there's any specific questions on the material that's there. The way that I make up the exam, as, sort of before, is I work from the capital letter pieces of the outline to make sure that I have coverage of most of those and I don't have a whole lot of coverage on the same thing. The test has 5 questions on it, but the first 3 questions are each worth 25 points, and you're supposed to pick 2 out of the 3 of those. That's where a lot of the explanation comes from. There'll probably be a couple of those that have no math at all in them, and then maybe the other one has some number crunching and some writing to it. But the exam is designed for you to pick the 2 of those that you think you have the best grasp of the material. If you want to answer all 3, I will take the best 2, but it's designed for you to pick 2 of those. Then that's followed by 2 problems. The next problem is a weighted average cost of capital problem, and it's a weighted average cost of capital for a company that everybody's heard of, not some weird company. It is the kind of thing where I try to make it as realistic as possible in that I give you a whole bunch of information and you take that information and make the assumptions that you need to estimate the weighted average cost of capital for that firm. Everybody should have a different answer, but I would bet that the answers will be within 2% of each other, between 7 and 9 or between 6 and 8, just because you're all working from the same information. I might give you a value line sheet as part of that WAC because that's a way to collect, sort of efficiently a lot of information, or I might give you the Bloomberg sheets. I might give you a graph of interest rates. I, could give you the tables of the historical market risk premium and bonds and bills and stock averages. I might give you a screenshot of Demoteran's website. I might tell you to use assumptions that you used in your project, tell you to make your own assumptions for some of that market data. So it's kind of up to you, thank you, to be, ready to answer that material, either using what you know from market data or using the market data that I give you. Then the company specific stuff, I have to give you that about the firm in some form that you have seen before. And it'll ask you to estimate the cost of equity a couple different ways. Probably it replicates pretty closely the assignment from the project. So a couple different ways on the cost of equity. I'll give you some information to estimate the cost of debt. You have to do the math and get the weights right. You probably have to calculate your own weights. Bound to be some sort of judgment explanation. Why did you do this, or why did you pick this and not that? Pretty standard weighted average cost of capital problem. Then the last problem is a discounted cash flow problem where you have to fill in a column of a DCF. Sometimes it's the last year, sometimes it's the first year. Somewhere you have to fill in a column and then do the bottom part of the calculations. It's not like you have to fill in 5 years of, 25 lines or anything, but you have to do an annual DCF calculation. And then the number crunching at the bottom that takes you from enterprise value down to equity value. And you'll probably have to make some comments or some judgment calls on that in a way that, I kind of give you a chance to decide, if you were doing this for a company as part of a job or as part of a job interview. That's going to be another company that you have information on that either you've heard of or you can kind of figure out what's going on with that firm. And the number crunching, the DCF number crunching parts, probably, 10, 12, 15 points out of that question. And then the rest of it is interpretation or some kind of judgment call. So there shouldn't be any surprise at all about what's on the exam. I don't intend for there to be. Yeah. Mm-hmm. Yeah. Mm-hmm. It's the WAC and the DCF. And they're each worth 25 points. These formulas are going to be there on the front of the test. It doesn't say anything about defining, what is the G or what is the T or any of that stuff. But these are the same formulas, the way they appear in the notes. So they're going to be there just on the front end of the exam and sort of leaves your brain free to interpret rather than to just memorize things. then the outline doesn't quite chronologically follow the material, but it's pretty close. In that, when we first came back after the midterm, we spent a day and a half on just kind of introducing the math or the calculation part of discounted cash flow model, starting with a reduced form model. So those were all based on some sort of cash flow of $3.50 a share or whatever in the examples, and then moved into Walmart after we talked about the sort of different forms that the models take. And I would figure that if I asked you, to explain or compare, contrast, decide when you should use one of these or when you should use another one of these, that anybody can write a couple sentences on what situations each of these apply to. Or if I give you the information about a company, you can decide, is this a constant growth company, or is this a super normal, or is this a constant payment? That you're familiar enough with the underlying assumptions that you can pick which one to use. So there's really 3 of them, and we didn't spend much time at all with constant cash flow. So then it kind of boils down to either Gordon or the H model, which is the supernormal growth model form that we used in here. And we spent a whole bunch of time on Gordon just because we use it in a bunch of different ways. And there's a question on the old exam about that. But we use the Gordon model and the formula for the Gordon model to solve for any one of those pieces. And if you have everything but one, mathematically, you should be able to back out of that model the one piece that you're missing. Why didn't I give you the Gordon growth model formula? Well, that's one reason, but yeah, my... Yeah, so if the Gordon is just a form or a reduced form of the H model. A Gordon has how many growth rates? 1. So there's no subscript. The short is equal to the long, and that means here this whole term disappears, and what you're left with is Gordon. And we spent a little bit of time on what cash flows, and people that used the Gordon model as a way to estimate the cost to equity in the project. If you used it and you just used dividends in the numerator, I probably wrote you a little note that said, what about share repurchases? Because companies that repurchase shares on a regular basis, the market expects that to come along with dividends. Why do companies repurchase shares at the same time that they pay dividends? What's the reason for that? Pardon me? Who has to pay taxes? The owner of the stock. Dividends are taxable income, and the investor has no choice. But repurchases, how do you avoid tax as a shareholder on those repurchases? When the company goes out, well, yeah. Well, that's if you sell your shares back when they repurchase. Then you can turn dividend income in. Yeah, the share repurchases reduce the amount of shares outstanding, which means your shares are worth more if you don't sell them back. So if you don't sell them back, you don't pay tax at all, but eventually the gain is taxed as a capital gain. So there's a little tax strategy in share repurchases instead of additional dividends. What's another reason why a company, might want to avoid paying a huge dividend one year and use stock repurchases instead? Yeah, people like to see dividends increase. So if it's a dividend increase that you can't sustain, it's much better to use that money to repurchase shares instead, because then you don't get your shareholders expecting this continual growth in dividends off of a big base. And then in the context of looking at cash flows that go to the shareholders, we went back over the sort of principle of consistency. And instead of looking at some measure of cash flow to equity, we calculated cash flow to the firm. And this is just another version of this principle of consistency. In the first part of the class, it was does the numerator and the denominator and the multiples match? So enterprise value to sales or price to earnings. Does the value that's in the numerator on those multiples match the cash flow that's in the denominator as far as who it belongs to? Here, I'll come back in just a second, Jackson. Here in the principle of consistency in this part of the class, we tried to make sure that we knew the difference between the cash flow that belongs directly to the equity holders and cash flow that belongs to both the debt and the equity holders, or all of the suppliers of capital. And that's kind of the leap between a constant growth or a dividend valuation model based on cash to the shareholders. We sort of expanded that application and applied it to cash to the entity or cash to the entire firm that belongs to both debt and equity holders. Yeah, Jackson. Right. That's another word. Well, enterprise and entity are the same. Yeah. Mm-hmm. Yeah, but it's the cash flow doesn't have the payment to the debt holders taken out yet. That's what makes it unlevered. So it's before the allocation of whatever the firm has earned in cash terms gets split between the interest piece that goes to the debt holders and the residual after taxes that goes to the equity holders. So as long as it's something that's based on before interest, they call it unlevered because the obligation to the leverage piece hasn't been taken out. Now the free, what does it mean when it's free cash flow? After CapEx. So unlevered is before interest, free is after CapEx. So it just kind of depends on where you stop as you're going from the top of the statement down to the bottom. And, another way to sort of try to recognize which cash flow you have is if you see a cash flow statement that starts with revenue, is that cash flow to the firm or cash flow to the equity holders? The firm. What does the cash flow statement start with if it's cash flow to equity? Starts with net income. And once you get the starting place settled, cash flow to the firm is revenue, EBITDA, and you make your tax adjustment and your working capital adjustment and your CapEx adjustment. The cash flow to equity is net income. Then you make your working capital adjustment and your CapEx adjustment. So it's just where they start that they're different. At the very top. At the bottom, they're both the same. Now here's where the order sort of diverges a little bit, because in class, we just used the Bloomberg WACC to start and did the whole DCF thing. But on the outline, I think it makes more sense to stop, at least for a second, and talk a little bit about the weighted average cost of capital. And this should be really fresh in everybody's mind just because you just did this and you just turned it in. But companies have debt, hopefully traded debt, so that it's easy to find the cost of debt. Some firms have a whole lot of debt. Some firms have so little debt that, it's 2% of their capital structure and it doesn't matter at all what you choose as the cost of debt. Some firms, 70% of their capital structure is debt, and it's a really important piece or a really important part of the WACC. Everybody's got equity. Everybody's got publicly traded firms. So everybody has to deal with the different ways to estimate the cost of equity. And, sort of in general, we did some kind of a reduced form, either constant growth or H model that you solved for the cost of equity. Let me go back up here if I can. Here on this one, if you plug in everything on the top, make an assumption for everything on the top, and GL on the bottom, you can solve this for the required return, either in the H model form or the Gordon form that doesn't have this piece here on it. So you can solve this to get a required return on equity. That's one sort of general way to estimate the cost of equity. And the other sort of general way is with some form of capital asset pricing model. And, every now and then somebody says, are you going to give us the capital asset pricing model formula? And I say no, because if you don't know that by now, every single class, it's been there. So I figured that's one that everybody can commit to memory for 2 hours. And the CAPM comes in a bunch of different forms. One is what we sort of call plain vanilla, the standard one that was done by the people who first drew up the model. Another one has some adjustment to beta. Instead of just using the beta that comes from a regression of your company's returns against the market returns, you make some adjustment to the beta, either based on what Bloomberg does, and I'm sure that you'll have copies of a Bloomberg beta or two on the exam, and all that data comes in a separate packet. Or there's the Basicek adjustment, which instead of the adjustment, what does the Bloomberg beta adjust to? Yeah, it adjusts towards the market, either from below or from above. So depending on how close the beta of your company is to the market, the adjustment to the market is either pretty small or pretty big. What does the Basicek beta adjust to into the industry? And it depends on whether you think your firm over time is going to move more towards the market or more towards the industry. And if you think that your firm is going to become more like either the market or the industry, then you can make one of those adjustments. If you don't think it's going to move towards something, then don't make one of those adjustments. Just use some estimate of a beta. And I wish I could get everybody their own Bloomberg machine and just send you off to estimate your own betas, but I can't do that yet. 10 years from now, we'll probably all have Bloomberg feeds on our phones or something. But in the absence of that, I'll probably give you a sample of betas. And I think last year I gave them 4, and you kind of had to, they were 2 different market indexes and 2 different time periods, and you had to just look and decide. And there's no real right answer, because you got betas everywhere. There's Yahoo betas, there's value line betas. Everybody can estimate a beta. What you want to try to do is match the characteristics of the estimation to what you think fits best for your company, long-term or short-term. Some people said, well, I like value line because it's a very stable beta. It is, because of the way that they estimate it. Where Yahoo, they only go back 2 months. So Yahoo betas bounce all around, up and down. But somebody who's doing this, kind of on a regular basis, has to make a choice about what interval, how many years, whether it's monthly or weekly or quarterly or daily or whatever you choose to use, and also has to choose a market portfolio. And some of you guys use the Standard & Poor's. Some of you use specific, like almost ETF type things for specific to retail. Some people use the Dow. Some people use the Russell. I might give you choices of different indexes and let you pick a beta based off of that. So you have to kind of make choices when you implement the capital asset pricing model. And one of the things that people don't like about CAPM is that you have to make all these choices. And sometimes your answers are different depending on those choices. And sometimes with CAPM, it just doesn't work very well. In fact, a lot of the time, it does not work very well. So Fama French is sort of the go-to adaptation that instead of trying to adjust a beta, what Fama and French did, instead of trying to adjust a single beta, what did they do? Yeah, they added 2 betas in the basic Fama French model. There's a market beta, there's a size beta, and there's a book to market value ratio beta. So they added those extra 2 risk factors. There's market risk, there's size risk, and there's the ratio of book value to market value risk. And to find those extra betas, you have to have a multiple regression. And if I'm going to give you that, I'm going to have to give you the multiple regression analysis results and just ask you to use those. And there's a pretty good sample on the old exam, so we'll see that there. The trick to sort of realize is the reason all these people spend all this time with either adjustments to beta or multi-factor models and, how many additional risk factors are there, is that either CAPM or any of these alternatives doesn't work very well. So if it doesn't always work really well, people are looking for some better mousetrap. And when you guys go through this weighted average cost of capital estimation, you're going to have to think. Anybody who uses this sometimes has to make some judgments about what to use for a beta or, what to use as a market risk premium. There's a lot of judgment in here. So you won't all have the same answer, but they'll be in a fairly narrow range. Yeah, Kim. Mm-hmm. Mm-hmm. The Fama French. Yeah, it just wasn't much better in terms of a goodness of fit than just the single factor model. One, I think the size premium was significant, but the book to market premium wasn't. So there's just not much difference between, how do you measure goodness of fit anyway? Yeah, the R squared, the adjusted R squared just wasn't much better. Yeah, it'll show you the R squared and the adjusted R squared. And with some companies, Fama French is much better because the R squared is much higher. But for Walmart, it's just not. Yeah, Peter. No. Yeah, we have to use the adjusted R squared because the adjusted R squared takes into account the fact that the Fama French has 3 factors that it can use to explain returns on the dependent variable, the company returns. So that gives it much more power than just a simple 1-factor regression. Mm-hmm. Yeah. Uh-huh. Right. Yeah. So you'll see in the results on the old exam, I gave you both the simple 1-factor and the 1-factor spread regression, and then the Fama French regression. Yeah. Mm-hmm. Yeah. It's slightly different because the way normal CAPM is run, it's the variables, both the independent and the dependent, are just returns, weekly returns or daily returns. In Fama French, the way they wrote that model, and they had to because of the way their other factors were constructed, is they wrote their model in terms of the independent variable and the dependent variable are market return minus the risk-free rate and company return minus the risk-free rate. It's just a series of observations. So it's daily observations on the market risk premium. And if you wanted an estimate, you could average all of those over time. But it's called a spread regression because the risk-free rate subtracted out from dependent and independent. And they had to do that statistically. Yeah. Mm-hmm. Yeah. No, they're not. In regular CAPM, your independent variable is weekly returns on the Standard & Poor's over the last 2 years if it is the Bloomberg default. And your dependent variable is weekly returns on the stock over the last 2 years. In Fama French, that form of CAPM is the weekly return on the market minus the risk-free rate, that observation for that week, the 10-year or whatever you want to use as the risk-free rate. And then for the dependent variable, you take the stock return and subtract the risk-free rate. So it's a spread. Slightly. Mathematically, if you play around with it, what's different is probably more time than I want to spend on this. What's different is you can turn CAPM into a spread regression. The alpha is a little bit different, the constant term, which makes the slope coefficient, the beta, a little bit different, but it's not a lot different. You'll see in the old exam. And you'll see when we did Pharma French in class, the worksheet has the base regression in one file, and then it has the spread regression in the next file, and they're pretty close. Then, after we talked about how CAPM is not perfect, people use CAPM for a variety of reasons that I think everybody can probably come up with one or two. And there's, the single factor, constant growth or H model to find the cost of equity doesn't always work well either. For some companies, they don't return cash to their shareholders, so you have to use CAPM. For other companies, trying to figure out what cash flow the market is pricing can be a little difficult. So most people are trained to use CAPM. It can be used for every company out there that is publicly traded. And what we tried to do in here is hope that if you used a couple different ways to estimate the cost of equity, you'd have pretty similar results, so you'd be, relatively confident in those results. Then, the actual WACC mathematics, you got to decide what counts as debt, and this is all sort of a review from the first half. If there's any stronger claims, you need to decide about operating leases. You need to decide whether or not you want to use net debt, as long as debt is bigger than cash. These are all sort of judgments that you make based on the situation that you're in. And finally, sort of stress that the weights, especially for equity, you want to make sure that you use a market value weight for equity. Book value for debt is okay, but you don't want to use the book value of equity. Why not? What's the big issue with the book value for equity? Yeah, for most companies, it's a lot lower than the market value. So if you use book value, you end up with a lower WACC or a higher WACC than if you use market value. Lower, because you de-emphasize equity, and you're de-emphasizing the most expensive or the cheapest piece? The most expensive piece. So you want to make sure that for equity, at least, you use the market value when you find the weight. Right at the very beginning of the weighted average cost of capital, we had this little digression on return on invested capital, which is sort of a parallel to return on equity. Because in an entity world where you're trying to value the whole company, there's capital provided by the equity guys and there's capital provided by the debt guys. And Bloomberg has a way of computing return on invested capital that happens to be based on the book value of equity. And I don't know why they do that, because you can use the exact same figures that Bloomberg gives and find the return on invested capital based on equity. But, given that the shareholders want a return to be earned based on the value of their investment in the company, to me it makes much more sense to compute return on invested capital at market. And then we'll go through an example of that. But the only other sort of important piece of return on invested capital is adjusting for the interest cost and trying to figure out what the return the firm would earn would be if it was done on an unlevered basis or before interest. So you make a little tax adjustment there. Then the very last day, we spent a little bit of time on levered and unlevered betas. And those are ways to adjust the risk of the equity position as the amount of debt changes. When you acquire a company and you're going to change its capital structure, that's going to make an impact on the riskiness of the equity position. And there's a problem, sort of another application of that in the practice lever and unlevered beta calculation that I handed out. So there's another little thing that you can practice there. But levering and relevering really just depends on being able to plug and chug stuff into this formula. So this is 1 minus the tax bracket, and this is debt to equity. The only thing that I see sometimes people mess up on is this math here, that inside the parentheses, you have to do this multiplication first, then you add the 1, and then you go on from there. So don't ever separate that term. It's always 1 minus t times the debt over equity ratio. Yikes. Where'd I go? Yeah. So before we talked about levered and unlevered betas, we spent a little bit of time on mergers and acquisitions. None of this, the unlevered, levered beta, or the M&A stuff, was on that spring exam. But this M&A stuff was just vocabulary. There's like 5 slides of, what is a financial buyer, what's a synergy, economies of scale and scope to try to explain why one company buys another, and a little bit on how you might be able to manipulate the earnings of a combined company by strategically acquiring another company. And then we spent a lot of time on the IHOP acquisition of Applebee's and either what that would have done to earnings per share if it had been an equity acquisition, or what it did because it was an acquisition with a lot of debt. So that changed the capital structure and increased the equity cost because of the increased risk to the equity position. And one last little bit was Derek on Monday, and I came up with yesterday, sort of a little outline piece on the stuff that he talked about, or the stuff on his slides that I thought was important. So it was kind of my take on what to take away from what he said. He was in a much better mood this time. He doesn't think so, but he was in a much better mood this time than he was last time. I don't know whether it's that he grew up in Japan or what, but this was a much better mood than the last time. And you certainly ought to see him at the neighborhood parties, because he's not a life of the party person. He's a very serious, he does what you ask him to type of person. And that fits pretty well with the kind of work that company does. And they said to him, go out and find these deals. And that's what he does. And he's very well paid for doing that and for being able to try to explain the strategy and the things that HIG does to make it work. And this is the first time he's disclosed anything much about their returns, sort of their overall returns. How, in our world, how on earth do you earn 50% returns on things, even with leverage? So they've got to be really good at what they do. And they have nice cars and that. They're at the 1450 building and they have their own floors in the garage. And he's right, there's nice cars on those floors. Now, that is, sort of everything except the DCF. And we spent so much time, and everybody's done their own DCF models. I hope all of the terminology makes sense. How you do the calculations, revenue to EBITDA, to take out the taxes, add back depreciation and amortization, go from that to cash flow based on CapEx and non-cash working capital. What happens when you get to the end of your cash flow? You've got to decide on how you're going to value the rest of time, either with a multiple or some form of a growth model. Then the mechanics of discounting. You don't have to do that by hand. You might have to discount 1 year, but you certainly don't have to discount 5 years worth of cash flows by hand on the exam. And, sort of the basic definitions, I think everybody knows by now, but ask if you don't. If you go through the DCF, and I will give you an example of the one on the old exam. In the material, it says that the company, which is a firm called Cognizant, which is a provider of sort of technology consulting services, is trading at 65. And the first time I did that DCF, I got $40 a share. And I said, that can't be right. There's got to be something wrong. If when you go through and do your DCF calculations, you come up with a value that is really different from what you know is the price of the share, raise your hand or ask, I'll come and look. And it turned out what I did on the one that I was doing is for the continuing value, instead of discounting the free cash flow in the last year, I discounted the present value of the free cash flow in the last year. So that's what gave me the $25 difference. And when I did it right, the DCF value comes out to be pretty close to the market price. So I'm not going to set you up with a DCF that gives you a really weird number compared to the market price. You will still have to make some assumptions. Either how to figure continuing value, what to use as a multiple for continuing value, what to use as a growth rate, something so that everybody, again, will have different answers. So if you walk out and say, I got $47, and somebody else says, oh my God, I got 42, don't panic, because you could both be right, just depending on the assumptions. And it's just a way to test and see if you can handle the mechanics as well as make some judgments. There will probably be something in there somewhere that asks you to either compare this company to the firm that you did your project on, or use some of the values that you used for your project, and I'll have a little note that says tell me, because I may forget which firm you did your project on. But I figure even if it's next Wednesday, you still remember enough about what you did on your project that you can use that in the exam, to set some ground or give you something to compare to. Questions on the DCF? Yeah, you bet. It's hard, really, really hard. How to estimate the long-term growth rate. The standard, sort of academic answer is that the long-term growth rate is high enough to keep the firm interested in whatever its core line of business is, but not high enough to attract competition. That tells you nothing. 10% is too high, because a company that grows at 10% is going to attract competition. And, 1% is probably too low for everything except regulated utilities and things, because, 1% isn't high enough to keep Chipotle interested in coming up with new menu items or whatever. Another answer is that the weighted average of all of the publicly traded companies, kind of in the country, grow at about the same rate as the economy grows in nominal terms. And some of those firms are riskier than the overall economy, and some are safer. So if the overall economy is growing at 3%, the firms that are riskier than the economy as a whole might grow at 3.5 or 4, maybe 5, maybe, if they are really, really jazzy firms. And the ones that are safer, might grow at 2.5 or 2. If you're in the student fund, we had a guy who used to be an investment banker in one night, and he said the highest long-term growth rate we ever used was 3.5%, period. That was some rule in the firm that he worked for. You don't use anything higher than 3.5. But I have seen other DCFs that have something higher. I don't think I've ever seen anything higher than 5% or so. The other rule has to do with the WAC and the G. What's the smallest difference that you should get away with between the WAC and the long-term growth rate? Yeah, Kim. Pardon? 2%. And what's bigger, the WACC or the long-term growth rate? The WACC. So, you can't get away with assuming a WACC and a G that are so close together that your calculation explodes. Yeah, Adriana. No, the WACC can be greater. You can have a 10 WACC and a 3 long-term growth rate, but you can't have a 4.5 WACC and a 3 long-term growth rate. So, and the companies that the long-term weighted average cost of capital is only 4.5% are the really safe, stodgy companies that aren't growing very fast anyway. Yeah. Sure. Mm-hmm. Could be. It's pretty long. You got to have a reason why you think it's going to be that long. I would think that those long transitions come for what kind of companies? It could be startups. And, what does a company sort of have to be able to grow at a lot higher rate than the long-term normal growth rate? They have some kind of innovation. How do you protect innovation? Patents. What's the other, I can't remember if this was the first half of the class or the second half. Moats. Some long-term competitive advantage that would give you that long transition period. When I was doing this for Macy's, Macy's does not have, it's a store, in retailing. So far, there isn't any real long-term competitive advantage. So for Macy's, I don't think you could get away with a 30-year transition period. Anything else? I think that's it. Is there one more thing? No, just an extra page. Okay. All right. Just to recap, what I do when I put the exam together is I'm making check marks at these big things. So if you look at that, capital letter label, and it says, deriving the input assumptions, that you can talk to yourself about where those input assumptions come from. You want to close this, or maybe not close it. Let me go back here and get to the old exam. So this is the real final. And the other thing I need is the data. Last year I realized when I looked at this that I had gone to the Berkshire Hathaway annual meeting, and I got back like 2 days before the final exam. So that's why the little bit of the joke that was on the back of the exam was on there. I typically don't put a joke on the back of the exam. I typically do bring in, separate page, 6-8 pages of data where I think I have everything you need. Now, a couple times it's happened where I think I have everything you need and I don't. So if you think there's something missing, just ask. And I'll either tell you, yeah, it's missing, let me run, go get it. Or I will tell you to, use your judgment or to make that assumption based on some other information and just explain your assumption. But I try to give you all of the outside data that I think you need. And that's what's in that data packet. It turned out that when I posted it, whenever I posted it last week, the balance sheet for one of the companies, Cognizant, I think, wasn't in there. So I had to go find that balance sheet and repost it. But I'll check, and hopefully I'll bring it all. So here are the beginning questions, and they are pretty, the first one anyway, is pretty general. There's no math. There's just, talking. And on the original test, you have more space than this, but I mushed it together since I made you a copy. And, here, I'm sure this has happened to some of you, that it's 11:30 on Friday and you're in this lab and somebody blows in, and obviously someone who isn't as prepared as you are, and starts asking questions. So, what's continuing value? What does it show in a DCF? Yeah, Kim. Yep, the firm lasts forever. The paper runs out after 5 years or 10 years, but the firm continues to generate free cash flow, unlevered free cash flow. So you're trying to capture that. Why, continuing value is kind of the modern popular phrase, but why is it also known as terminal value? The firm doesn't end. Well, when the forecast period ends. So it's not that the firm ends, it's the time that you are willing to project specific cash flows for it. So 3 ways that you can estimate continuing value are what? 3 different models. Comps multiple. What else? Gordon, 1 single stage constant growth, or 2 stage, supernormal and long term. And there's actually more, but those are the 3 that we used. And, this thing about which of the 3 did you pick in your project and tell me which project, and that's just a way to link what you've been doing, working so hard on all semester to the exam. How do you know whether or not to choose a constant growth or a 2-stage growth? How do you make that decision? Yeah, Peter. Yeah, is the growth rate at the end of the forecast period what you think is the long-term normal or pretty close? Then you can use a Gordon. But if it's still 10, 12%, then you got to use a 2-stage. Even if it's 8%, you got to use a 2-stage. The people who used multiples, why did you use the multiples? If you used an enterprise value to sales or enterprise value to EBITDA or enterprise value to EBIT, yeah, Luke. To compare your firm to the industry, what do I have to assume about your comps valuation if you use a multiple? You like it. As a firm, it was easy to find comps. It took you 2 minutes to find 10 comps, and the multiples for those comps were all very close together. If you had to struggle to find comps, then probably you're going to use some sort of a growth model. Now this one, I struggled with how to write this, and I know that I answered this question 25 times this was a huge class last year, but the way that I wrote this, even though I struggled with how to write it, drove people crazy. I didn't mean for it to. If you see something in bold, it's because I want you to pay attention to that. So what I was trying to get at here is on the DCF, there is a line labeled changes in net non-cash working capital. And first of all, how is that value computed? How do you come up with that? Or how does Bloomberg come up with that? Yeah, Kim. Sort of. It's changing current assets minus cash as a quantity and changing current liability. Because these are non-cash current assets. So if current assets go up on the balance sheet by more than current liabilities go up, is that going to show as a source of cash or a use of cash in the DCF? Use. The sign flips between the balance sheet and the cash flow statement. That's what I was trying to get across here with this bold stuff. So if the entry is taken from the balance sheet and the change in non-cash working capital is positive, do you like that if you're a cash flow investor or no? No, because that means there's more money invested in additional assets than funds supplied by an increase in current liability. But this was torture, and I finally just said to people, do your best, because I couldn't figure out any other way to explain. So what's a sensitivity table? Yeah. Yep. Change, sort of little incremental changes in important components in the DCF. What happens to the share price if you change those over some relevant range? Why is it so important to put at least one of these into a DCF? Yeah, Mike. Yeah. Yeah, these are all estimates, going out into the future. We certainly aren't going to be incredibly accurate with these. So you want to see how sensitive your equity value is if you're high on the WACC or low, or high on the growth rate or low. And, of course, the book, with one chapter in the book. But here's something about the book where it talks about good points and bad points about DCF relative to comparable companies. And you can all go read at the end of the comparable companies chapter, there's a good points and bad points about comps. And at the end of the DCF chapter, there's a good points and bad points about DCF. Now, I think that the Bloomberg wording has actually changed since I wrote this exam. But back then, it had other non-cash adjustments to income, and I can't remember if they have that now or they've split these out into, sometimes they show stock-based compensation and then they show other, so they've changed their format a little bit. But, what's an adjustment, or what's stock-based compensation, first of all? Options. And, how does that, what part of that options process shows up as a other non-cash adjustment to income? It's stock-based compensation, and it's a plus on the cash flow statement. Yeah. Nope, it's not that. Because exercise has some cash component to it. Yeah, the granting of the options is non-cash. Why? Yeah. You just give somebody a piece of paper. Here's your right to purchase shares at this price for this many years. So accounting treats that as a salary expense, but it's a non-cash expense. What's the other big non-cash expense? Depreciation. Another expense on the income statement, but not a cash flow. So the cash flow statement adds back depreciation and it adds back stock-based compensation. Then there's a couple others. One has to do with changes in deferred taxes, but the biggie here was stock-based compensation, and that used to be just in the total. Now in the new Bloomberg, it's separated out. Now, then the second piece, all non-cash adjustments to income appear in two different places in the DCF. So the biggie here is depreciation. That's the big non-cash adjustment. So two places that shows up in a DCF. Where and where? Yep. Gets subtracted out to figure the tax bill, then it gets added back. Because it has a tax impact, but not a cash impact. Two different ways we use the Gordon model. Yeah, Kim. Mm-hmm. Yep. We used it in continuing value if you want to use it out there. Find the present value of a perpetual unlevered free cash flow growing at whatever rate you assume. And you can use it to estimate the cost of equity by working backward through it. What does GL stand for? When you see that little L. Yep, that's the long term. And here's the question that Yubo had about economically, what are the constraints on G sub L? And then mathematically, how high a value you can assume for G sub L. I have seen people assume a G sub L higher than the WACC. What does that, nobody did that this year. If you assume a G sub L higher than the WACC, what's that going to do to your continuing value? Yeah, it's going to make it negative because the denominator is going to be negative. That's a little weird. So, for sure, you don't want your G sub L higher than your WACC. And the rule is that the G sub L should be at least 2% lower than whatever the WACC is. So, two differences between Gordon and the H model. There are two terms in the H model that are not in Gordon. Yeah, Jackson. Yep, the short-term growth rate. Does that have to be higher than the long-term growth rate? It does not have to be. Still works. G sub S, can be whatever you want it to be. And the model will work as long as the numerator is positive. Because G sub S is just in a little spot. It's only in the numerator. It's not in the denominator. And the transition. How long does it take to go from growing at whatever you assume is the short-term rate to whatever you assume the long-term rate is? So which of the two is more useful, you think? Yeah. No. I don't think so. I don't know. To me, this is one of these things that's obvious, but maybe it's because of how long I have been doing this. Suppose I only let you use a two-stage growth model DCF. How could you turn it into a Gordon DCF? Make the short term equal to the long term. So really the short term is a subset of the H model. It just got to the point where it was easier to put all three of them up there rather than to have to keep going through them. So here's the old stuff that Derek talked about. But, he talked a lot about the same thing. There's a slide on how the things that HIG does as a private equity buyer to increase revenue. There's a slide on what their advantages are. And it's not that HIG is the only private equity firm that does this. This is what they all do, and so they all sort of apply the same rules when they go in and buy companies. Yeah. It can't be so big that you attract competition, and it can't be so small that the firm gets bored, decides to let itself be sold. That's what happened to Applebee's. They ran out of growth opportunities. They're like, fine, we give up. Find somebody to pay a nice big premium for us and let us go retire. So I think you can still answer D given what Derek talked about on Monday in his slides. This one about turns, when he was here in the spring, instead of talking about multiples, he called them turns. So a multiple of 6 times EBITDA is a 6 turn. I left this on here because, why does HIG focus on EBITDA instead of net income? And all private equity buyers do. Why do they focus on this? Yeah. Yeah, they may not have net income. Yeah. Mm-hmm. Yep, they're going to buy the whole firm. They're probably going to add some debt. That means interest is going to change. Depreciation. What happens to depreciation when one firm acquires another one? Yeah, it changes why. Yeah, the assets get revalued, so depreciation is different. So here were 3 little vocabulary things. You talked about different vocabulary. You talked about hair this time. Recutting is just going back after due diligence and lowering your offer. And asset light are companies that don't have a lot of assets, which means they don't have a lot of what? don't have a lot of depreciation, and before you get depreciation, you don't have a lot of CapEx. They don't like firms that, one of the things you said on the way down is that they turned down the ability to buy a trucking company because somebody said, I don't want to have to replace these effing trucks every 3 years. I don't care how good a deal this is. I don't want to have to worry about replacing the equipment and making the CapEx investment. So, third one, why is the cost of equity so crucial? Two reasons for most companies. Yeah, usually the biggest, always the most expensive. So even if it's not the biggest, it's the most expensive. Most everybody uses CAPM. And most of them agree that the equity risk premium is the hardest thing to measure. Why is it so hard to measure? Yeah, Peter. Yeah, you got to define the market, the alternative investment space. Is it just stocks? Is it other asset classes? The direction of the equity risk premium. There's a lot of people who don't like using historical, sort of averages for the equity risk premium. Why not? What's wrong with historical, Jackson? Pardon me? Well, some finance does, but equity valuation doesn't look back, it looks forward. So what you want to do is try to figure out what people are expecting going forward, not back in, 1960 or whatever. Now we talked about 3 different methods. One is the historical averages. That table you can update every year. You can get it from Demoterin. What else did we use for the risk premium? 2 other things. Yeah, the ISA survey data. They survey all these people. And what else? Yeah, Luke. Well, but you'd have to either go back historically. Yeah, I mean, you can't just use it as of today. One, you've got to, have some time dimension to it, but there's another way to measure it that sort of starts from that premise, but it also looks forward. Yeah. Now, those are all based on history. But what's the other big way to get the equity risk premium that everybody loves because you can go to the website and pull it down? Yeah, the Demoterin method. He backs it out of what is actually a different form, but, sort of a modified form of the H model, but applied to the whole index. So if I go back up here, and there's no way I would ask you to do this, because I couldn't do it unless I had a whole bunch of work studies, is here, this cash flow is dividends on the Standard & Poor's. And he makes a supernormal growth assumption about dividends on the Standard & Poor's, a short-term growth rate and a long-term growth rate. And then he solves this for this required return implied by the current level of the Standard & Poor's and subtracts the long-term growth rate to get an estimate of the premium. So subtracts the risk-free rate to get an estimate of the premium. So it's a form of this model where he uses a 2-stage growth model to get this R, and then he subtracts the long-term treasury. It's fairly sophisticated, but thank goodness he does it, and every single month, at the beginning of the month, pops back up again. So I did not look to see what it was as of the 1st of December. You have the November in the notes, I'm pretty sure. But, as of the 1st of December, there's a different value. And at the end of class, if we have time, I will find that. And that's one that nobody's going to argue with you about if you use that. Now, something I missed when I put this final up is there's an article. It's called Best Practices in Estimating Cost of Equity or something like that. And I didn't give it to you because it's just like 10 pages of the results of this survey of executives. So here, this question mentions an article that you haven't seen, but still I figure the question is okay. Market value weights, most people use market value weights. What's the other kind of weight that you could use? Book. And we already talked about why it's better to use market value, at least for the equity component. Now, firms internally sometimes use book value weights. Why? Why might a firm use a book value weight? Internally, yeah. They're looking at capital that they have as a firm. Why might they think that their internal cost of capital is lower? Yeah, Jack. Yeah, it's a way to be, sort of standardized over time to measure performance. Because if you use book value, what you're using is the book value of an equity plus retained earnings every year. So that gives them an internal dimension. And that's the capital they have the ability to use. If you're an outside investor, you want to make sure these guys are earning a return on the value of your investment. So you are hoping that they're going to beat their book value internal estimate by enough to compensate you based on the market value of the equity. And then there's some pages for Macy's. And one other thing I'm going to say, there's one person in here who knows Macy's really, really well. But, I'm not going to use a company that one of you guys has done a project on and knows better than anybody else. So nobody did Macy's last year. So there's a return on invested capital calculation for Macy's. Let me see if I can find the sheet of stuff that we need on the desktop. Oh, shoot, where's the desktop? Oh, no. I copied it. There it is. Let's see if I can make it bigger. Up here. Thank you. All these screens are different. So here's a whole bunch of data on Macy's. Here, market cap, we're going to need that. We're going to need debt, because debt and market cap together are the invested capital. Then, because we're trying to find these values based on the firm, not based on the equity position, return on invested capital is sort of an enterprise-based value. The sort of standard way that this is computed is based on operating income, which is here, 2887. Oh, where's the pen? I see the pen. 2887 adjusted for the impact of removing interest and removing the tax deduction for interest. So return on invested capital is an unlevered type calculation. So I need somewhere down here, interest expense is $393, and I can see taxes if I'm staring at this at my desk. Here's income tax expense. So I need these things. Oh, taxable income, that's one other one. Where did it go? Here, 23. So I need some kind of a tax bracket. And it's really hard to write on this and have any kind of eye contact with you, so give me 2 seconds. So that's a 36% tax bracket. That's the only information you have on a tax bracket for Macy's. If you had a value line sheet, where would you get the tax bracket? Yep, it's on the right-hand side. It's about halfway down. So that's another place you can get a tax bracket. Now the interest piece, $393, reduces the tax bill that Macy's paid. Reduce that income tax expense. Why? Yep, interest is tax deductible. So without this interest, would they pay more taxes or less? More. How much more? This thing that the corporate guys call the interest tax savings, the tax you save because you have the interest payment, is the tax bracket times the interest, and it's a big whatever my calculator is. $141. So in the return on invested capital world, there's something called cash taxes, so taxes based on operating income. That would be the taxes that they paid. What? Oh, that's right. We'll see you later. This is so cool. You know, one of these years I'll learn to use this more during the semester. The cash operating taxes are the taxes that they paid plus the additional tax they would have paid if they didn't have the interest tax deduction. And together, those equal 1,005. Now, all this is jargon, and the jargon all comes from the fact that it was created by a consulting firm. And it was created by a consulting firm and then kind of adopted by everybody else. So in the return on invested capital world, we talk about net operating profit after taxes. So just what was generated from the operations, not from the financing, but on an after-tax basis. And that's going to be the operating income, the $28.87, minus the taxes that they would have paid if they didn't have debt. Oh, so that's going to give you 18. And if I divide that by the invested capital, that's the debt plus the equity. And of course, I don't remember what that is, and I'm not going to go back and look. The total of the two is 24,331. And that equals 7.7%. So that's the return that Macy's earned on its invested capital. What would you compare that to if you wanted to try to decide if the people who were running Macy's were doing a good job? The WAC. You want them to earn their WAC, at least. Yeah, if you don't have the tax bracket, you got to find it. Yeah. Yep, so if you don't have the tax bracket, you find it. Then you add to the actual taxes paid, you add back the subsidy the firm earned on its tax bill because it had interest. So the argument is that if it didn't have any interest, its tax bill would have been $141 higher. Add that to the taxes actually paid, and you get an estimate of the taxes that would have been paid if there was no debt, if there was no interest. So those are the taxes based on operating income. Subtract those cash-based taxes from the operating income, which is the EBIT, so it's before interest. Subtract that from the operating income, and then divide. So you have sort of after-tax operating profit. Divide that by the invested capital, which is the market cap plus the debt. And nobody's asked, but yeah, you could adjust that for net debt if you want to. This is all non-GAAP, so you can compute this anyway you want to. So then there's a whack question. And I think I have a horrible feeling that if I move this, the writing stays on the screen, right? Oh no. Oh God, that's really cool. Okay. So the whack question. So 4A said, use this information and come up with a CAPM cost of equity for Macy's. And you have 4 betas. You have a long-term and a short-term against, I cannot believe that this says Dow Chemical. That was not supposed to be Dow Chemical, but I didn't even notice this until now. Everybody took the whole exam not noticing that this is Dow Chemical. It should have been the Dow Industrial. But no wonder those things were so weird. Okay. Never mind. Let's just ignore the 2 Dow. See, that's the kind of thing that I don't notice. Nobody who took the exam noticed. I didn't notice when I looked at this earlier today. You just kind of get conditioned. That should have been INDU. So we'll just concentrate on the Standard & Poor's. I know those are the Standard & Poor's. I don't do that. Anyway, here is a 2-year beta and a 10-year beta. Is Macy's getting safer over time or riskier? You think? Here's the 2-year beta. Here's the 10-year beta. Yep, getting safer over time. Sure, I think. I zoom in, it doesn't fit real well. So this is the 2-year, from last spring. And here's the 10. Yeah, so the 2 year's a little bit less than the market, but the 10-year was big, 1.7 or so. So it looks like Macy's is getting safer over time. Based on this, I would use something around 0.9, and probably all of you would use something between, 0.9 and 1.1, maybe, yeah. That's fine. If you want, but that's going to give you a very different cost of equity than I was just looking at what happened over time. Yeah, you think about 2005 to 2015, that was the whole financial crisis. So lots of companies were really risky during the crisis, even a retailer. So this is just 2013 to 2015, but this is an opinion. And it said explain your choices. And if you said because the R-squared was higher, that was fine. Yeah. Okay. It's up to you. You can pick. All this says is, use the CAPM beta to estimate a cost of equity. And back then, the market data, I have it somewhere. The market data in the packet. The risk-free rate was at about 2, and it was lower than that. 2 was lower than it had been, so I don't know, I probably would have used 2.5 or something, just because we also know interest rates are going up. But these are all, there's no one answer here. So this is just me. I would probably have used about 2.5 and a beta of, I don't know, 0.95 maybe. And the risk premium stocks over T-bonds been 4 to 6% on the averages that are here. Demoteran's equity risk premium, the implied one, was 5.8. I think most people probably would use something between, 5 and 6. We used 5.5 in class, so I'm going to use that for the RM minus RF. And now I just have to multiply. 2.5 plus 0.95 times 5.5% equals 7.73. I'm trying to move a little quickly. Here's all the data. I want to go back to the last page here. Here, for the Vasicek beta, you need an industry. And Macy's is a retailer, kind of a general retailer. So the industry beta is 1.03. The firm beta that we used is about 0.95. And the R squared for that beta is around, just look, 0.23 maybe, something like that. .24. So if you use the most recent 2-year beta, this is what you'd have for Vasicek. If you use the long term, you'd have a different R squared. But all the Vasicek beta does is weight the firm beta and the industry beta based on how good the R squared is, or how strong the fit is. So this is the R squared times the firm beta plus 1 minus the R squared times the industry beta. You get about 1, and then you would multiply by 5.5 and add the risk-free rate, and you'd have another cost of. The one based on a beta of around 0.95 is up here somewhere. Next, where did it go? 7.7. I'm just going to use that one going forward. The other one's a little bit higher, but just again, in the interest of time. I have to go back now to the exam and get the rest of the information. So here is Vasicek. Or sorry, here is a Fama French. That's the third piece after we do the Vasicek. And here, this one doesn't ask you for just a plain CAPM based on the regression. It just asks you for a Fama French. So you only have the Fama French output here. But you can see that the independent variable that represents the market is the Standard & Poor's minus the risk-free rate, because that's the form that this model takes. So the dependent variable, which you don't see, is the return on Macy's minus the risk-free rate. And here there's a beta of about 0.9. I need to look at where I took my notes just so I get the math right on this. And then hopefully if the RF is 2.5, your Fama French cost of equity is the risk-free rate plus this beta times the market risk premium plus 0.14 times the risk premium for small firms minus big firms minus so it's a CAPM formulation, then it's got two additional terms. Math-wise, does the small minus big firm size or high minus low book to market add much to the cost of equity? Why not? The percentages are small, 1 3/4 and 1.5 relative to the market risk premium. The coefficients are, teeny, 0.14, 0.22. One's positive, one's negative. They're going to cancel each other out. And significant. You mentioned significant. How do you tell if those extra variables are significant? Yep, the P is not anywhere close to being as low as it's supposed to be. It's 0.77 and 0.66. And the R squared, the adjusted R squared, is smaller than what was on the Bloomberg sheets for the simple regression, a single regression. The adjusted R squared is low. So Fama French did not add a lot there. Here you had to pick one and explain why you didn't like the other two, but they're all pretty close, so there's not a lot of agonizing here. Bonds, you need this for the cost of debt, and if you look through the bonds and you cross out any that are callable, that's the first step. Puttable, thinkable, all you want is these ones that say at maturity, bullet. And then, out of these ones that are at maturity, you cross out any that are really short maturity. What's left? Around 4.2, 4.3%. Whether you average or you pick a couple specific bonds. So everybody has pretty much the same cost of debt. Whoops. So now what I have to remember is for the cost of equity, I'm going to use 7.7. Use 36% for the tax bracket because we found that in the previous question. And there's one other thing I need. If you go to the highlights page, the debt is 7341 and the market cap is $22,238, if I'm reading this right. So when I did this math, I got about 25% debt. So now here's just the write out the whack calculation. And the way I think you ought to write it is to put everything in numbers except the two costs. So we have 25% debt times 1 minus the tax bracket times the cost of debt is 4.2% or so, plus 75% equity times the cost of equity. So this is just number crunching. Percentage of debt is the after-tax cost of debt, and the percentage of equity, which is what's left, times the cost of equity. Couple sort of inconsistencies that sometimes show up here. Suppose I had assumed 2% for the cost of debt for Macy's. You get away with the 2% cost of debt for Macy's based on our earlier calculations in the problem. Can't be smaller than the risk-free rate because Macy's is riskier than the U.S. government. So make sure that your cost of debt is not smaller than your risk-free rate. Suppose I had a 4.2% cost of debt for Macy's and 3.5% cost of equity. Why not? You're right. Equity is never, ever, ever cheaper than debt. Why? Yep, the debt guys get paid first. So your cost of equity is always bigger than your cost of debt, and your cost of debt for a firm is always bigger than your risk-free rate. Those are kind of the only rules. Oh, and the weights. You know, if your weight is 25% debt and 70% equity, that's happened. Something is wrong. Because the weights have got to add to one. But basically, all these WACC calculations are, you know, here's all the information, or here's some subset of all the information that you have. Grab the pieces and try to come up with a judgment. I'm going to pick on James. Do you remember what Macy's WACC is? Okay, so this is a little, but it's, you know, they got hammered 6 weeks ago, the retail sector. So this was in the spring. And, you know, most companies' WACCs are probably in between 5 and 10%. So if you get 25% or something, ask me, because chances are you've made some funky assumption. Now, here's one that I want you, this bonus, I want you to try for practice, just to make sure that everybody has the, just familiarity with that algebra. The trick, what you're supposed to do, is take the $3.59 in dividends plus the $12.56 in repurchases and divide those by the $3.77 to get a cash back to shareholders of $4.28. And, just go look at the stuff in the data packet, that highlights page. It'll show you revenue is growing really slowly, like 1% a year for Macy's, but earnings are growing at about 10%. So it depends on whether you believe that Macy's is a firm that's already at its constant growth stage. If it is, you'd use a Gordon model. If you think that earnings growth at 10% means that Macy's is growing at some supernormal rate, then you'd use two-stage. And I'll post the answers to both of those. So anything on the left. Yeah. You have to pick. Then the DCF, there's no way that I'm going to do all of this math in here. I'm going to post that also, but try for me. Fill in every single box if you haven't already. And then let me just briefly here, everybody I hope can define unlevered and free. Then here, there's a lot of choice in this. Would you choose constant growth or two-stage? I didn't give you multiples, but I made you pick constant growth or two-stage. If you happen to pick constant growth with this short-term growth rate of 10%, you're going to get very bizarre answers. Short-term growth for Cognizant is 10%. So this really is a two-stage growth model company, and I think the problem kind of steers you towards that, but I'll post my solution to that. Then the very last thing here has you, figure out the stronger claims. You had a balance sheet, or you now have a new balance sheet in the new packet, and you had cash and the other assets. When I did this, I came up with, when I did it with the right unlevered free cash flow, I think I got $58 a share, which is relatively close to the 65. And I assumed, my best guess calculations is that it was about a 20-year transition period down to a 3.5% normal growth. But any kind of two-stage growth model is going to get you relatively close, high 50s, low 60s as a price for Cognizant. And I think that was the end. I'm pretty sure that was the end. Oh, no, there was a bonus. Pick one of the two asset accounts and one of the two liability accounts, define each one, and, decide why you might exclude one. So what's goodwill? All the way back to the beginning, yeah. Yeah, if they pay more than net asset value for an acquisition, the rest gets dumped on the balance sheet as goodwill. Why might you exclude that from a DCF? Yeah, well, not anymore. With cash paid back in the past, that existence of that goodwill doesn't have anything to do with future cash flows. Deferred tax liabilities. What are they? How about pension liabilities? What are they? Some of you guys have pension liabilities. How do you find those? Yeah, somewhere in the balance sheet. Why might you exclude unfunded pension liabilities from a DCF? Yeah. Well, but they're stronger claims. So they're not actual debt yet, which is why you might exclude them. Why aren't they debt yet? Where did they come from? Pardon? Nope, not acquisitions. Yeah, defined benefit plans, money that, when are you going to pay out on those plans? When the people retire. So, who knows what's going on then. So these are like contingent liabilities. Same thing with deferred taxes. By the time the tax bill comes due, your tax position may have changed. So these are all just sort of maybes on the DCF. And I think that's everything, except this is true. You've got to keep in touch. And also the joke, which is not as funny in print, but it was hysterical to see an 85-year-old man say that in front of 40,000 people. He got a lot of laughs. So I will post the math solutions in the morning, and I'm going to save this and hopefully be able to add it also. And as soon as I get your project, if you give me your project to review, as soon as I get it done, I'll send you an email. Joe, I know you've been trying to find me. I just haven't been on email. Tomorrow. Yeah. Mhm.
So as far as this is concerned,
Mhm.
do you want me to hand it to you?
No, that's fine. Yeah. Well, I mean, how about this? If you want me to take it back, then I'll grade it. Yeah, that's fine. I'll put a grading sheet on. Yeah, I won't forget you, but when I, like here, there's some typos and stuff. So at some point, yeah, you want to, before you give it to anybody else, you want to fix those, but I'll just keep it. Where did Jackson go? Yeah, if you can grab him, ask him to come back too. Yes.
Yeah, I'm sorry.
That's okay. Yeah, that's fine.
And then I also overslept, so I didn't get this to you before noon, and then I tried to come to your office.
Yeah, I'll try. Yeah, I do them in order.
Yeah, okay,
So.
thank you.